Alright, now let's discuss factors that affect the exchange rates. These factors can be put into two categories. Number one, short-term movements, and number two, medium and long-term movements. The term movement is basically used because rates move upward and down. Of course, if you are to be given the daily exchange rates, and for some reasons you are asked to plot them, okay, most likely you end up with something like this, okay, depending with the direction. So this is what we say here, that the rates moves up and down. That is to say, maybe today the rates are up, then tomorrow they are down, stuff like that to the end. Okay. Now, short-term movements simply means all those factors which have a short-term effect on the exchange rates. Central bank's intervention, either by purchasing or selling its own currency or the foreign currency, is one among the short-term factors that contribute to short-term movement in the exchange rate. Then there is the political and economic factors. Political changes, that is, changes in policies that is being pursued by the country, or economic changes in the monetary policies. These two can as well affect or have an effect in the short-term movement of the exchange rate. Speculation in the movement of the value of the currency. Speculation is, for instance, some individual came up with some issues, maybe claiming that interest rate will rise or interest rate will be decreased, or maybe the rate of inflation, forecasters predict that it will rise or it will go down. Alright, so all those are speculation. Now, speculation also will have a certain effect on the rate of exchange rate. That is, it can cause the exchange rate either to go up or to go down, depending with the direction of what actually happened. There can be some technical factors, that is, for instance, year-end accounting periods and deadlines, commercial transactions, for example, export time for agricultural products, say coffee, tea, and cotton. Remember, once we harvest and we want to export, it means the importer will demand your domestic currency in order to be able to purchase whatever you are exporting. Now, if your currency is in high demand, it means that exchange rate will go up simply because the price of your currency will rise as well. All right? But all these are short-term factors. Why? Because once the harvest period is over, it means most likely the situation will be reversed. Okay. Now, what about medium and long-term movement? Medium and long-term movement simply means all those factors which have a long-term effect on the exchange rates. Now, these can be, for instance, investments, that is, direct and indirect investment, or public and private investment, relative movement in the interest rate, that is, suppose that there are some changes in the interest rate, funds will tend to move where the interest rate is higher. Increase in demand for the currency, and hence the exchange rate will as well rise. Remember the other day I gave you an example of two countries, that is, suppose that we have two countries, say Kenya and Tanzania, where initially the interest rate is 4% in both countries. Okay, the interest rate is 4% in both countries, and later on there was an interest rise in Kenya, let's say from 4% to 6%. Okay, now if there is an interest rise in Kenya that is 2% more than what is in Tanzania, it means that it becomes easier to borrow in Tanzania and go to invest in Kenya. Now, when you go to invest in Kenya, you cannot use the USD, you cannot use the Tanzanian shillings, you cannot use pound or euro. You're going to have to purchase the Kenyan shillings that you'll use to invest in Kenya. Now, if you require the Kenyan shillings, basically what will happen is that the price for the Kenyan shillings will rise simply because the demand for the Kenyan shillings has as well risen. And therefore, if the price for the Kenyan shillings has risen, it means its exchange rate has risen as well. Relative rates of inflation, that is, increase in inflation rate, have a bearing in the exchange rate. How? Remember again, I gave you an example of two countries. That is, if a country has higher rate of inflation, it means its currency will become weaker. While a country that has low rate of inflation will have a stronger currency. Okay. Therefore, again, you need to recall this. I remember I gave you some example over this. Balance of payment position. Now, with the balance of payment position, here we need to look on the following issues. For instance, the deficit balance. Okay. Now, if you have deficit balance of payment position, what will happen, or what is the implication? It means you will demand more. Okay, you will have more demand of foreign currencies. Okay, now if the demand for foreign currencies is higher in your country than the demand for your currency by other countries, it means your currency will be weaker, and so the price will decline. Okay, remember, if you export more, the demand for your currency will increase. You do not export, the demand for your currency will decline. You have risen interest rate, demand for your currency will increase. The opposite, demand for your currency will decline. You have lower rate of inflation rate relative to the other country. It means again demand for your currency will increase. Okay, or your currency will become even stronger. So that being the reason, it will translate itself into higher price for your currency and subsequently a stronger currency or higher exchange rate, higher value of your currency. Now, that marks the end of the first segment. We're going to proceed with the other segment. Now let's continue with the management of foreign exchange risk or foreign exchange exposure. Remember, participants of international trade, we have the buyer and we have the seller. The seller is also known as the export, whereas the buyer is an importer. Okay, so we have the exporter and importer. All right. Now, if you sell on credit, it means after some times you will be rewarded. That is, you will receive some payments. And the payments can be in foreign currency, for instance, the dollar, the pound, the euro, Japanese yen, or any other strong currency. Okay, in most cases in the world we use these strong currencies for buying of goods and services across the international border. Okay. Now, this is the thing. Suppose that we have a Tanzanian exporter. Okay. We have a Tanzanian exporter. Now, the Tanzanian exporter, let's assume that has exported coffee. Okay. Has exported coffee to India, where he will be repaid. He will be paid Indian rupee. He will pay Indian rupee, let's say 2 million. Okay. Now, the problem here is that this Indian rupee 2 million, the payment won't happen today. The payment will happen, let's say, 90 days later. Now, within this period, within this waiting period, anything can happen. and whatever happens might impair the exchange rate. Okay, for example, if there are some favorable conditions towards your currency, the Tanzanian shillings, it means it will be expensive for the Indian importer to pay you because you'll have to use a lot of Indian rupees. Conversely, if the value of the Tanzanian shillings decline, the Tanzanian exporter will incur loss, whereas the Indian importer will be favored because he or she will use few Indian rupees to pay back the debt. So, as an exporter, you want to be in a position to protect your proceeds as against exchange risk. And to be able to do so, you need to understand different techniques that we use in order to protect against the foreign exchange risk. And this is the significance of this module or this session, management of foreign exchange risk. Risk in international trade are the major barrier for the growth of business all over the world. The assessment of risk in international trade plays an important role in declining the mode of payment to be the settlement between the seller and the buyer. Okay? Once you know the risk, you will be in the position to decide on how you should get paid. Like, do you want payment in advance? Okay? Or do you want to afford open account? Remember, open account, documentary collection, and letter of credit. 3 methods will have some sort of delay before you could receive payment. Let's say 30 days, 60 days, 90 days, etc. Okay, before funds are received by the seller, the exporter. During this window, anything can happen to the exporter's domestic currency against foreign currency. That is to say, if for some reasons exporter's currency decline in its value, then exporter will lose some money. However, if the exporter's domestic currency appreciates in value, then the exporter will win. Either way, as an exporter or importer, you need to understand different techniques that we use to cover against foreign currency exposure. But first, let's see, what do we mean when we say risk? Risk simply means uncertainty. That is, the likelihood what you expect isn't actually what will be the final outcome. You expect to receive A, you end up receiving B. You expect to receive B, you end up receiving C. That is what we call risk. Risk is a situation that involves an exposure to some danger. The possibility that something will go wrong, something will not be in your favor, and therefore you end up losing. Now, what are the risks that we expect to face in international trade? As an exporter, the first risk you should expect is the payment risk. Exporter might be paid for the consignment sent only after the sale of goods. This is open account. Again, under the letter of credit, payments are made only when all terms and conditions are fulfilled. Remember, under the letter of credit, if you violate any of the terms or conditions that are set forth under this letter, you want to be paid. And the more you delay, the more time will lapse before you could get paid. And in the worst case scenario, you might end up not being paid at all. Okay? So, between that window, again, there can be differences in the exchange rate. Importer may default due to financial difficulty and fail to carry out his contractual obligation. Again, there can be blocked payments due to government to foreigners while a contract has already been signed. I think you guys must remember at one point in time we had mineral extract ban. Okay, so if you expect to be paid and there is a ban of either the raw materials or payments, it means already you are in risk of losing whatever you expect to receive. Imported goods may be disapproved by importer's country. Why? Because of some standards. Remember, there are some standards that are set forth by the country of import. And if the imported goods do not meet the required standard, automatically they will be rejected. Likewise, there are some issues such as quota or avoidance of dumping, etc. Okay, that can as well delay even payments. Now, as an exporter, what will you do, or what are you supposed to do in order to reduce or to minimize payment risk? To succeed in minimizing the payment risk as an exporter, number one, contract under advance payment. Remember, under advance payment, suppose that we have the seller and the buyer, exporter and an importer. Under advance payment, the buyer is supposed to first make payments, okay? Make payments as per the agreement. Once the exporter has confirmed that indeed payment is into the account, it then and only then the exporter will send goods and documents. So you can see that by using advance payment, you guarantee to receive payment on time. Right? Therefore, as an exporter, we strong advise you contract under advance payment so that you avoid delayment in the payment. Number two, obtain payment guarantee. What is a guarantee? A guarantee simply means a third party agreeing to be answerable, agreeing to be responsible just in case the principal debtor does not meet their contractual obligation. Suppose that you are an exporter who is supposed to ship some cashew nuts to a certain importer in Bangladesh. And this importer wants you to first ship the cashew nuts before he could pay you. So let's say now the deal here is open account. Do not reject. What you can do is that you ask this Bangladesh importer to take a bank guarantee, okay? And a bank guarantee can be in form of, let's say, the payment guarantee, okay? By taking the payment guarantee, the importer's bank guarantees to make payments to you just in case this importer does not pay. Therefore, again, you can see here that you have covered yourself against the risk of default. Just in case the Bangladesh importer does not pay, the bank will pay you. And then the bank is the one that will deal with that particular importer. Now, if you have contract under the letter of credit, comply to the terms and conditions of the contract of sale. Remember, the contract of sale has a number of issues that you need to fulfill. First is all about type and quantity of goods. 2, agreed price. 3, delivery date. Okay, and 4, documents to be produced. Therefore, comply to these terms. If you comply to all these terms, you're minimizing the chance of default. If you do not comply to any of the terms, for instance, if you deliver goods at the very late date, the importer won't tolerate it. You will be penalized. So you do not want to create the room for such a thing to happen. Comply to the terms that you have agreed. Request for status reports on importers. International trade involves buying and selling of goods across border. Now, if you are a Tanzanian exporter, all right, you are a Tanzanian exporter, and you're supposed to ship some goods to, let's say, a Chinese importer, okay, and it is your first time, you have never interacted with this Chinese importer, do not hesitate. In case you are skeptical, simply ask for status reports. Status reports will be issued by a bank. Okay. So a bank can confirm to you if indeed this Chinese importer has a very good reputation, financial sound, plus any other information that you will want to ask. Another form of risk that you should expect to come across in international trade is the market risk. Market risk simply means the risk of a product, price, competition, or ultimate buyer acceptability of the risk or rejection due to change in consumer demand and taste. Okay. There is fashion. Okay. Fashion changes all the time. All right. Now, you produce a certain product today, and your competitor on the very same day launch not exactly the same product, but somewhat similar. Look at the competition between iPhones and Samsung Galaxy. Right? It's a very stiff competition. And in most cases, when iPhone issues a new version of the iPhone, Samsung will as well issue a new version of the Samsung Galaxy. Now, consumers, besides considering quality of these products, also they consider price. Now, here is where the risk comes. Your product needs to be competitive enough in terms of quality and the price so that consumers will accept it. Otherwise, it will be rejected. And also remember, the demand, preferences, and taste of these consumers change over time. There are some goods that are perishable or seasonal. Okay, so they pose a very huge market risk. Now, as an exporter, how are you going to minimize the market risk? Test the acceptability of new product in a competitive foreign market. See if your product is acceptable by majority. If it's acceptable, then you can produce some more and export to that particular country. And that's the reason sometimes you see the so-called the trade fair. Okay, like in our country we have the every July. Okay, Sabasaba, every July. Different producers will come to the trade fair to display and provide a detailed description of their products. That means they are marketing. They are marketing in order to see, number one, if their products will be accepted by that particular market, and second, if there is a competition, then what product pose a huge competition and how what can be done in order to beat such competition? We encourage an exporter to produce and export high quality products. Okay? So basically here, you need to meet the standard. Don't produce substandard goods. Okay? Because in international market, competition is stiff, your goods will automatically be rejected. Another risk that you should expect to face is inflation and interest risk. Inflation simply means persistent increase in the prices of goods and services. Now, if there is inflation, the price of anything that is imported will be high. Why prices of any imported goods will be high? It's because inflation causes domestic currency to weaken. Now, once the domestic currency is weakened as against foreign currency, it means anything that is purchased using the foreign currency will be very expensive in the inflation economy. Now, there's an issue of interest rate, okay? Because there is a close relationship between inflation and interest rate. And therefore, in case there is inflation or some issues with the interest rate, it can lead to some issues as well in the cost of financing of the international trade. As an exporter, how are you going to deal with this risk? Please contract a forward foreign contract or forward contract. Okay, that is, if you, as an exporter, if you expect to receive foreign currency, let's say you expect to receive USD 10,000 60 days from now, and for some reasons you think that there will be an inflation or anything that can cause the exchange rates to fluctuate, to change. In order to protect your proceeds, please enter into a forward contract where you will set a forward rate or a forward price, the price that will be used to buy or to sell your receipts. Another risk is the foreign exchange risk. Foreign exchange risk occurs due to the volatility of these foreign currencies. A risk taken when there is a need to buy or to sell foreign currency due to fluctuation or movement in the exchange rate. Now, foreign exchange risk can be grouped into three categories: transaction risk, translation risk, and economic risk. Now, let's start by exploring the transaction risk. Transaction risk arises from normal trading activities when goods or services are invoiced in foreign currency, but payable and receivable will be in future. That is to say, an exporter, this is Tanzanian exporter, has entered into a deal with an Indian importer, where the Tanzanian exporter is supposed to ship 1 ton of cashew nuts, but he will be paid the Indian rupee 450, 90 days from the date of shipment. Now, this is a typical example of international trade transaction where foreign currency will be received in the future, 90 days later. Now, we all know that there can be changes in the exchange rate. And the changes in the exchange rate can cause what you expect to receive to be different. Why? Because at the end of the day, after 90 days, if this importer remits Indian rupee 450, the Tanzanian exporter will have to change this into Tanzanian shillings using the prevailing exchange rate if he did not enter into a forward contract. Translation risk occur when there is a mismatch between the mix of currencies in which the assets are denominated and the mix in which liabilities are denominated. Okay, that is to say, in international trade, okay, we expect to have creditors and debtors. Okay, and a single company, let's say an exporter, okay, an exporting company can have both creditors and debtors. Can have creditors who are domestic based. That means they want to be paid using the domestic currency, and also they can be foreign based. That means they need to be paid using other currencies such as the pound, euro, dollar, or Japanese yen. Likewise, debtors. Debtors can pay you using the foreign currency as well. Now, at the end of the day, this exporter will have to translate these currencies into a single common currency, let's say the Tanzanian shillings. And there is where now he will face translation risk due to volatility of this currency in the time of translation or exchange. And what about economic risk? This refers to the effect of foreign exchange rate movement on the international competitiveness of the firm. And this is brought about by, let's say, the prices of raw materials in different countries, or the price of the value of the export in different markets. As an exporter, how do you deal with this risk? Please go for hedge. If you use the hedging technique, you can easily protect either your proceeds or the payment. Let me be clear on this. Okay, let me be clear on this. Suppose that you have a Tanzanian exporter who has entered into an agreement with a Japanese importer. Okay, with a Japanese importer, where the Tanzanian exporter will ship 200 tons of coffee to Japan, where the Japanese importer will pay a total of 2 million Japanese yen 60 days after the date of shipment. On the date that they entered into this agreement, the exchange rate of Tanzanian shillings vis-a-vis Japanese yen was 18/20. That is, 1 Japanese yen is sold at 20 Tanzanian shillings and bought at 18. Now, we all know that currencies, foreign currencies, are volatile. Okay, anything can happen that can change the exchange rate between the currencies. So 60 days is a lot of days. And again, we know that on maturity, the Tanzanian exporter, once receive yen, will have to translate yen to Tanzanian shillings. On the other hand, the Japanese exporter needs to purchase or needs to have yen so that he can make payments in Tanzanian shillings. Now, as for the Japanese importer, he will go to his bank to buy Tanzanian shillings using the Japanese yen. So, if the exchange rate is not in his favor, it means he's going to use a lot of Japanese yen to acquire the Tanzanian shillings that he can pay. What about the Tanzanian exporter? The Tanzanian exporter expects to receive the Japanese yen. That is to say, once he receives the Japanese yen, he will sell the Japanese yen to, let's say, a bank, so that he can be given the Tanzanian shillings. Again, if the exchange rate is not in his favor, for example, on the date where they signed the deal, the exchange rate was 18, and now 60 days later, the exchange rate is 15. It means the Tanzanian exporter is going to lose 3 yen for every single, 3 shillings for every single Japanese yen. Now, if you were to multiply 3 by 2 million, you'll see that he's going to end up with a loss of 6 million Tanzanian shillings. But if he decides to use the hedging technique, it will be easier for him or her to protect these proceeds against exchange rate fluctuation or the exchange rate exposure. Now, there are different hedging techniques that are out there, and he can opt to use any of them. For example, he can use the forward contract. He can use stable currency invoicing. With the forward contract, the exporter enters into an agreement with, let's say, a bank where he will sell the Japanese yen at a certain fixed rate on maturity, let's say 18.5 Tanzanian shillings per every single Japanese yen on maturity. That is to say, now, on maturity, if the exchange rate has declined, that is, let's say, initially the exchange rate was 1 Japanese yen for 18 Tanzanian shillings. Now, if it declines to 16 Tanzanian shillings, he can still sell using the 18.5. This is the forward rate. Okay, the rate that was agreed by both of them. What about stable currency invoicing? That is, you use a currency that you consider to be stable and strong, a currency that does not change every single day, so that you will protect your proceeds. Therefore, as an exporter, if the importer is requesting to make a payment, let's say after 90 days, and you know that your domestic currency is volatile, you can use stable currency. Stable currency or hard currencies are such as the USD, pound, euro, Japanese yen. You can as well use the Swiss franc, etc. Okay, but in most cases, you'll see that dollar is widely used for invoicing. Look at the Japanese car traders. Look at the Chinese exporters. Okay, they all give an invoice quoted in dollar. Why? They believe dollar to be stable currency if they are to compare with the Japanese yen and the Chinese one. Okay, so please opt for stable currency invoicing. If that is not the case, or that's not your option, then you can opt for currency option contract. Just like the forward contract, with the currency option contract, here you lock the price. Okay, you lock the price that you will use to buy or to sell currency in the future. So you can agree that in the future you will sell 1 Japanese yen at 18.5 Tanzanian shillings. So you lock the price. But what is the difference between the currency option and the forward contract? With the currency option, this is not binding contract. On maturity, if the market price is greater, than the strike price, then you can sell at the market price. Let's assume the market price is 20 Tanzanian shillings for a single Japanese yen. Then that means it is profitable for you to sell this Japanese yen at the market rather than selling at the contract price. The forward contract, on the other hand, is a binding contract. If you have entered into an agreement that you will sell currencies at 18.5 Tanzanian shillings for every single Japanese yen, then no matter the price on the maturity date, you will have to stick with your contract. For no reason whatsoever, you cannot excuse yourself from this particular contract. Okay. Now, another risk is known as the political risk. This is the risk that may arise due to the following issues. Number one, wars between countries. For instance, as we speak, there is an ongoing war between Russia and Ukraine. That means in those two countries, if you are to look the exchange rate, historical exchange rate of the currencies of those two countries as against, let's say, the USD or Euro, you'll see a major difference. Okay, that is to say, these currencies must have appreciated, whereas the ruble and the European currency have depreciated. Also, revolution can cause political risk. Nationalization, that is when the government decides to own all industries, factories, businesses, that's nationalization. Okay. Financial sector reform or privatization, all this can lead to political risk. And the other day, one of you asked me the reason for devaluation. When countries are into war, a lot of money is used to finance the war. Okay, a lot of money is used to finance the war. Purchasing military equipment is very expensive. Ukraine is into war with Russia. Ukraine does not have as many weapons, military weapons, as Russia. Therefore, in order to finance this war, Ukraine devaluated its currency by 25%. What is the meaning for this devaluation? Remember, besides other products, Ukraine is a major supplier of wheat, right? So by devaluating, it means wheat from Ukraine becomes cheaper, and therefore importers will opt to find a way to purchase this wheat from Ukraine because it's cheaper than any other alternative market. So you see now, they've devaluated in order to sell more, to export more, but this was maybe not intentional. They have been forced by the current situation, and that is to finance the war. Now, as for the companies that have offices in other countries, we call them foreign direct investment. Okay? There is a risk for non-renewal of licenses. Remember, some few years ago in our country, there are some mining companies whose licenses were revoked, and some were even expelled from our country. You guys must be familiar with acacia. Okay. So this can be one of the reasons and a very good example of political risk. There can be a risk of the imposition of an import ban after delivery of goods, and sometimes even an export ban. Remember, there was an mineral extract ban during the Acacia saga some few years ago. Most political decisions are made overnight, and in the morning is when they will announce. Okay? Therefore, one must look at the relationship which exists between the two countries and how the other country has been faring in the international scene. Ask yourself this question. China and India. Okay? China and India import cotton from Tanzania. But both China and India are very good producers of cotton. Now, if they are very good producers of cotton, why again they import cotton from Tanzania? They are trying to make a good relationship, can be political or business relationship between these countries. By opening its market for the Tanzanian cotton, then to pay the favor, Tanzania will as well open its market for the Chinese products or for the Indian products. That's how it works. Now, protection against foreign exchange risk. Foreign exchange risk are due to some changes, the volatility that I mentioned before. Now, the volatility of the currency can have positive change or negative changes. In most cases, positive changes will lead to a rise in the exchange rate. That is, the exchange rate of the domestic currency against other foreign currencies will be favored. The domestic currency will simply appreciate in its value. So, as an exporter, most likely you're going to gain. Negative changes will lead to a loss because your domestic currency will not be favored. Now, if it's not favored, it means its value is going to decline as against other foreign currencies. Therefore, as an exporter, most likely you're going to lose. Now, what do we protect here? Since we have already concluded that positive changes leads to a rise, then all we need to protect is the negative change. Okay, this is the one that we need to find a solution for. Now there are several ways for a firm to protect its business against foreign exchange risk. We've already discussed the forward contract, but we can as well use foreign currency account. How does this work? Consider the following example. You have a Japanese car manufacturer, let's say Toyota. Okay. This company produces different brands, different models of motor vehicles, small cars, and they ship these cars all over the world. This company needs to purchase raw materials. Right? The company is in Japan, where the currency is Japanese yen. But raw materials, Japanese has a shortage of raw materials due to a number of reasons, one being the nuclear bomb that happened in Nagasaki and Hiroshima back in those days. Therefore, Japan or Japanese manufacturers depends on the import of raw materials that they use. And these raw materials are invoiced using these strong currencies such as dollar. For that reason now, the Japanese will need some Japanese yen in order to purchase raw materials that are invoiced in dollar. In case the Japanese yen has depreciated in its value, it means a lot of Japanese yen will be used to purchase raw materials because they have to be converted into dollar. Now, since the value of the Japanese yen has declined, it means the exchange rate of the Japanese yen has depreciated, while foreign currencies such as the USD has appreciated. So you need a lot of Japanese yen in order to acquire the USD so that you can purchase raw materials. Now, what is the technique that the Japanese manufacturers or exporters use? The technique here is to have a bank account, okay, that is denominated in foreign currencies such as the dollar, euro, and pound. That is to say, in case the exchange rate is not in the favor of the Japanese yen, they will not use the yen to purchase raw material. Rather, they will use USD to pay. Now, how do they obtain these foreign currencies? When selling cars, the invoice is quoted in dollar. When you make payments, you'll make payments in dollar. That's the reason you will see in those invoices, it's written, ensure that payment is done in USD and not in Japanese yen. Why do they refuse payments to be done in Japanese yen? Because a dollar is stronger than the Japanese yen. And they can use dollar to purchase raw materials from the world market because a lot of invoices are in USD. Again, another technique to use here is the foreign currency borrowing. That is, if your domestic currency has depreciated in its value, you can borrow the foreign currency invests them somewhere else for some time, so where you earn some profit, repay back the debt, keep the proceed, and use the proceed for buying or for payments, your debts. Now, let me take you back to the forward contract. Forward contract simply means a contract between a customer with a bank where they will agree to buy or to sell specified amount of foreign currency on the future date using a price that is locked during the time of agreement, and that is the forward rate. A forward contract is a binding contract. For no reason whatsoever, you cannot excuse yourself from such contract. Once you enter into contract, you have to obey. Forward contracts are of two types. Number one, there is a fixed forward contract. A fixed forward contract simply means you enter into an agreement today between a customer and a bank, and then the currencies will be delivered on a fixed date in the future. For example, today, which is 24th February, you agreed with a bank, that is, as a customer, you will buy, let's say, 100,000 USD at a price of 2,300 Tanzanian shillings per each USD. But this deal will be fulfilled or will mature on the 30th of April 2023. Now, if it's a fixed forward contract, it means on this date, okay, it's only on this date the deal will take place, that the customer will buy this USD on this date. What about the option forward contract? With the option forward contract, the contract of the same nature, just as the fixed forward contract. However, there is a slight change. That is, there will be, the delivery, buying or selling of the currency will happen between two fixed future dates. For example, the dates here, the delivery date, that is the date that you agree to buy or sell, can be between 25th and 30th of April 2023. So you have option of exercising your rights of buying or selling between this date, that is 24th, 25th, 26th, 27th, 8th, 9th, or 30th. No more, no less. But with a fixed contract, with a fixed forward contract, you will only exercise your right on the specified future date. In this case here, 30th of April 2023. Now, what happens if a customer has entered into a contract with a bank? Okay, and what kind of contract? The forward contract. Okay. Now, let me explain to you first the difference between the forward contract and the option contract. All right. Number one, forward contract gives the holder of the contract right and obligation. Let me write them, these two contracts here. Okay, here we have forward contract, and here we have the option contract. All right. Now, please pay attention to this. The forward contract gives the holder right and obligation. Right and obligation. To do what? Right and obligation to buy or to sell. Or to sell specified amount of foreign currency, let's say 100,000 USD on maturity. Let's say the maturity is 30th of March 2023 at a specified rate, okay, called forward rate. Therefore, let's assume that the forward rate that will be used to buy or to sell these currencies on the 30th of March 2023 will be 1 USD for Tanzanian shillings 2,350. This is the agreement. Now, with a forward contract on maturity, in case the exchange rate is in the favor of the customer cannot excuse himself from this contract. Why? Because forward contract is a binding contract. What I mean is, if it happened that on the 30th of March, okay, on the 30th of March, the spot rate at the market is, for example, 1 USD for Tanzanian shillings 2,200, and the customer had entered into a contract with the bank to buy. Okay, the customer is supposed to buy 100,000 USD from the bank at the forward rate of 23.50. Even though the buying rate, okay, the selling rate at the market is lower than the selling rate on the contract, still the customer cannot excuse himself from exercising on the contract and go ahead to buy on the market, because he will be penalized. There is a serious penalty here. Why? This is a binding contract. The customer needs to perform on the contract. Now, with the option contract, it's different. Why is it different? The option contract provides the buyer, the customer, right with no obligation. Okay, this contract provides the holder or the customer right without obligation. Right for what? Right to buy or to sell specified amount of foreign currency, let's say the same amount, that is 100,000 USD, on maturity. Maturity is the same, 30th of March 2023, at an agreed price, which is called exercise price or strike price. Strike price or exercise price. And the strike price or exercise price here is the same. Let's say 23.50. Okay. So this is not a binding contract. This is the difference between the option contract and the forward contract. However, now, for the customer to be granted this right, he or she will have to pay premium to the bank. Now, the premium can be, let's say, Tanzanian shillings 100 for every single USD. That is to say, now a customer needs to pay a total of 1 million. This is going to be 10 million, right? Because it's 100 multiplied by 100,000, right? So the customer will have to pay upfront 10 million. Okay. The customer will have to pay 10 million upfront so that they can be granted the right to buy 100,000 USD on this date. Now, in case on the 30th of March, this is maturity now, on the 30th of March, the exchange rate turns out to be selling 1 USD at the market is sold at 2,000. Okay, it means it is cheaper to buy at the market rather than buying at the contract. Therefore, the customer simply do not exercise. Let the contract expire. There will be no penalty. Why? Because already this customer has paid a premium upfront of 10 million Tanzanian shillings. So the bank will keep this money. If the customer do not show up, do not exercise on the contract, bank will not refund. This money will be kept by the bank, so it's lost. Therefore, before the customer decides on whether they should let the contract expire, the customer is supposed first to be sure if it is profitable to buy at the market. Now, remember the customer has paid 100 for every single dollar. So in total, if the customer is to buy at the market rate, it means it will be 2,000, and he has to put into an account that 100 that he paid as a premium. So the market rate now will be 2,100, which is lesser than the contract rate of the strike price of 23.50. That being the case, it is better for the customer to forget this contract and buy these dollars from the market. This is the benefit of the option contract. Now, with the forward contract, I said that if the customer defaults, there will be a penalty. And that penalty will occur when the bank is closing the contract. And the bank will perform what we call a closeout. So now let's discuss what is a closeout. The forward exchange contract is a binding contract, and each party is supposed to meet its obligation under such contract. It may happen that for some reasons, the customer fails to meet its obligation either in full or in part. Technically, we say this customer has defaulted. Now, in case of a default, the bank has no any other alternative except to close out the forward contract. The closeout of this contract is done by calculating the value of the transaction on the material date, that is maturity date, using the spot rate ruling on that date and compare with the agreed rates on the contract, and then the banker pass entries respectively. So, in summary, the bank will buy. Now, suppose that a bank customer called Freddy. Suppose that a bank customer called Freddy has agreed to sell. So Freddy will sell some foreign currency to the bank. Let's say Freddie will sell 100 USD to the bank on maturity date. Hello? Hello? We andika chochote tu, haina shida. Andika hata DP, haina tatizo. We have a bank customer called Freddie who has agreed to sell the bank, okay, let's say TCB, 100,000 USD at a price of, let's say, 2,350 per dollar. This deal will occur on the 30th of April 2023. In another way around, if Freddie, the bank customer, is selling, it means the bank, that is TCB, the bank will buy. Okay, the bank will buy USD 100,000 on this date at an agreed forward date, which is 2350. Now, on maturity, the customer, Freddie, defaults for any reason. If Fred defaults, what happens is the banker is supposed to close out this contract. How the banker is going to close that contract? The bank will buy foreign currency, that is 100,000 USD at the contracted price or the forward rate. The forward rate, remember, is 2,350. Therefore, the bank will buy this USD, the forex USD. The agreed here amount is 100,000 at the contracted price. Now, after buying this currency, the bank does not keep them in the banking vault. The bank will as well sell them to the market using the prevailing rate. And remember, I told you, every single date, okay, every single date, there is a prevailing spot rate. So let's assume that on the date of closing the contract, that is on the 30th of April 2023, okay, the spot rates were 2,320 up to 2,400. Therefore, the bank is going to sell. The bank is going to sell. Remember, the bank has just bought USD from Freddie at 2,350. Even though Freddie has not appeared to the bank, this is the procedure. Okay, so we assume that we as banker have purchased 100,000 USD at this rate, and now we're going to sell them at the market rate. Now here the selling rate will be 2,400. This will be the selling rate. Okay. Now after selling the entire amount, which is USD 100,000, what next? The bank will compute the difference between the spot price and the forward rate in order to obtain net balance. Okay. So to get now the net balance here, to get the net balance, what will happen is you take the difference between selling and buying. Okay, that will be the difference. For example, if the bank will buy 100,000 at this rate, we have to multiply this rate by 100,000, right? So we're going to end up with 2350, 1, 2, 1, 2, 3, right? So in threes, okay? 235 million. That will be the buying. And selling, the selling will be 240 million, right? This will be the selling. How did I get this? Is by taking 2400 multiplied by 100,000. Right? Now, to get the net balance, all I have to do now, the bank will take selling. Selling is 240 minus buying, which is 235 million. The difference here will be how much? The difference is 5 million, right? Therefore, the bank will credit or debit. Now let's see. Here it says the bank will credit or debit the customer's account with the obtained difference. Now the difference here is 5 million, which is positive, right? Now if the difference is 5 positive, it means this was supposed to be a profit to the bank. Now if it's supposed to be a profit to the bank, it means now the bank is supposed to debit customer's account, and the customer's account goes by the name Freddie. So debit Freddie's account with what? 5 million. Had it been the opposite, that is, if the difference had been negative, it means the bank is the one that has incurred loss. Therefore, the bank was supposed to credit Freddie's account with the same amount. But in this scenario, we see that the bank is going to earn a profit of 5 million, and therefore that is the exact amount that's going to be debited from this customer's account. That is how you close out a forward contract. Now, let's use this question to practice closeout of the forward contract. An East African importer XYZ Limited entered into a contract to purchase 2 buses from China and was supposed to pay a total of 400 USD on 28th of October 2018. XYZ Limited did not wish to speculate on foreign exchange, and so on 28th of July, the directors arranged a 3-month fixed forward contract for the bank to sell them USD 400. Okay. Now on October 28th, 2018, XYZ Limited realized that payment for the vehicles had to be deferred to 28th of November 2018 due to delay in the shipment of their vehicles. They approached their bank for the extension of the forward contract for a month, and their bank agreed to the extension to the request. Required: calculate what XYZ Limited would have paid if the forward contract was closed out, okay, and a new contract for a month arranged at the normal rate. So So you do not want anyone to ask you to close out the contract. Why? Because it is a normal procedure, okay, that if a customer defaults, you as a banker supposed to close out the forward contract, all right, before you could extend or before you could open a new contract. So the customers just come to request an extension of the contract. Fine, we agree. But as a banker, before we extend the contract, first of all, we need to close out the previous contract. And that's what we're going to do here. Now, in order to close out the contract, there are some issues. There are some issues that we have to do. Number one, we need to identify the kind of quotation. Now, to be able to do so, first of all, we need to see the rates that were provided on the 30th or on the 28th of July 2018. Hello. Naam. Nisubiri nitakupigia baada ya dakika 10. Haya. Now, on 28th of July 2018, the spot rates were UGX for USD, the rates are 37.50, 37.60. These are the rates. Now, you can see that in this scenario, USD is a foreign currency, whereas UGX is a domestic currency. Okay? And from the question, it is clearly stated that East African importer, so that's to say XYZ is East African importer. Now, we know that UGX simply means Ugandan shillings, whereas USD is the United States dollar. So in East Africa, USD is the foreign currency, which means now it is the base, whereas UGX is the price currency. That qualifies this one to be termed as the direct quotation. Now, under direct quotation, the higher rate will be selling rate and the lower rate buying rate. Therefore, 37.50 to 37.60, 37.60 is going to be the selling rate, whereas 37.50 is going to be the buying rate. 3 months forward, we're given 8 and 5 premium. Under that quotation, premium are supposed to be added to the spot rates. Now, the highest premium is going to be added on the selling, so that selling will continue to be high, whereas the lowest premium is going to be added to the buying, so that buying will be low. Now here we're going to end up with 37.55 by 37.68. Okay. So what will be the rate, the forward rate applied in this case? In the question, it is clearly stated that XYZ Limited wants to buy. Okay? XYZ Limited wants to buy. That means the bank is going to sell. Therefore, if XYZ wants to buy, the bank is going to use the selling rate. Therefore, the rate of interest here is this one and not this one. So I can even cross this one. I don't need this. This is my rate of interest. Now, how am I going to close out this forward contract? It's easy. Number one, the bank will sell USD. Okay, so bank sell USD 400,000 at a rate of 37.68, which is the agreed forward rate. Now all I have to do is to multiply the 400, okay, by 37.68. Here you're going to end up with what? 15,072. Okay. I'm gonna get rid of all these zeros. I don't need them. Alright, so I'm going to end up with this one. Next, bank, as I told you before, the bank will buy. Okay, so the 400 USD that the bank is going to sell to XYZ Limited, actually the bank is going to buy them from the market. Okay, so the bank will buy 400,000 USD from the market at the prevailing market rate, the spot rate of that date. So we need now the spot rate on the date of default. Remember, the date or the maturity date was supposed to be October 2018. And this is the date that we're going to close out the contract because XYZ Limited has defaulted. Now, the spot rates on these dates are 37.45 by 37.50. Since this is direct quotation, then this one is gonna be buying rate and this one the selling rate. Now the rate of interest here is the buying rate because the bank is gonna buy. Therefore, buy rate is the rate of interest. So we don't need this one. Therefore, here it's gonna be 400,000 multiplied by 37.45. Again, get rid of all these zeros. What will I get? $14,980. All right. Now, number 3, you're supposed to compute net debit. Net balance. All right. Net balance will be the difference between selling and buying. So the bank has just bought the USD, okay, 400 USD at what? At a price of 14 and sell them at 15,000. So we're going to take 15,072 minus 14,980. Here we're going to get 920. Now remember our 5 zeros, 1, 2, 3, 4, 5. So 1, 2, 3, 4, 5. Now in threes and in threes. All right. Now this is positive, which means to close out the contract, the bank will have to debit this amount from XYZ Limited account. So from XYZ Limited account, the bank is going to debit the 92. Oh, I think I've added one more zero here. So it's supposed to be 920. Excuse me. Okay, so it's going to be 9,200,000. That's what the bank is going to debit from XYZ Limited and extend the contract. That's how we close the forward contract. Now, part B of the question requires you to calculate what XYZ Limited will pay on 28th of November if they perform fully under the extended forward exchange contract. Now, if the bank has agreed to extend this forward contract, basically what will happen here is the bank is going to use the October spot rates and adjust with the applicable premium or discount in order to arrive to the appropriate forward rates to be used in November. Now, the October spot rates are, in October, the spot rates are 37.45 to 37.50. Okay. Now our interest is the selling. This one. This is our interest. You don't need this one. Now, since this is direct quotation, again our interest here is going to be the highest premium, which is 3. Okay. So the rates to be used in November is going to be 37.53. Now, if XYZ Limited perform fully in November, how much will the XYZ pay? It's easy. All you have to do is to take 400,000 multiplied by 37.53. Okay. By doing so, you're going to end up with 15, 0, 1, 2, so in threes. Okay. This is the amount that XYZ is going to pay on maturity. And that way, we've closed out the contract, forward contract, and extend or open a new contract.